This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in this section of Chapter 12, we look at two very specific issues that may arise in very specific circumstances, and how do we deal with them. The first one is where we have a transfer of assets between a husband and a wife, or between civil partners. Again, the rules are the same, whether it's a transfer between spouses or between civil partners there. The issue being, when we move assets from one spouse to another, we know that we normally, on an outright disposal, will use sales proceeds or will use market value when transferring such assets. But where we have a transfer between these individuals, spouses or civil partners, then there is a special rule known as a no gain, no loss transfer. That you'll be seeing early on in this particular lecture. Followed by part disposals. Odd concept there, you might think, a part disposal of an asset. How can you sell off a bit of an asset and not all of it there? Well, it's more easy than you might think. The reason being, for example, you buy a parcel of land of 10 hectares, and at some point in the future, you dispose of some but not all of that land. You maybe sell 6 of the 10 hectares. Now, you know what you sell those 6 hectares for, you know what your selling expenses are, but what you know the cost of is the cost of the entire parcel of land, the entire 10 hectares. So the problem there is, how do we work out allowable cost? Now, the rules that deal with both no gain, no loss transfers between spouses and civil partners and dealing with part disposals, those rules and techniques to follow have not changed since Finance Act 19. They haven't changed for a long, long time before that either, nor are they likely to change in the future. The only issue you'll see that when dealing with the transfers between spouses and civil partners, those transfers, I use a class example, and that class example, obviously taken from the FA2019 lecture, uses an AEA for each spouse of £12,000. That clearly now would be £12,300. But the rules, the techniques that we follow are exactly the same. Hence, therefore, you're now about to see our lecture from Finance Act 2019. As ever, enjoy. In this session, now having already dealt with the basics of CGT, how we calculate gains, losses, how we bring them all together to establish taxable gains, and then how we proceed to work out the CGT liability on those gains. Having done that, we now look at some special rules that apply in specific circumstances, any one of which, of course, could be tested within your examination. The first of those circumstances now to look at are where we have a transfer of assets between spouses, husband and wife, or between civil partners. Again, as we know from our income tax studies, whether we're talking about spouses or civil partners, the rules are exactly the same so far as the tax system is concerned. I said there were some special rules, and so it is here if, again, we'll just refer to spouses now, but again, remember, whenever I say spouses, I also mean civil partners. But if one spouse transfers an asset to another, then the rule is that that asset will be transferred on what we'll refer to as a no gain, no loss basis. We deem a consideration that would give rise to neither a gain nor a loss. And what that basically means is it transfers at cost. Whatever was the cost to the transferor spouse, that is the figure that we use on a disposal, on a transfer to the other spouse. It doesn't matter whether any actual proceeds are involved. This is not a claim or an election, as you'll see in the note. It's a rule that transfers between spouses will be dealt with on a no gain, no loss basis, which means they transfer at cost. So if one spouse has an asset that they had bought for £20,000, it is now worth £30,000, and let's say husband transfers that to his wife. On that basis, we ignore the £30,000 current market value, something we don't normally do. We usually, if it's a gift or sale at undervalue, we usually talk in terms of used market value, but not now with spouses. In terms of these transfers between spouses, no gain, no loss, it's transferred at cost. Therefore, cost to the transferor spouse, to husband I suggested there, 20,000, current market value 30. It transfers at £20,000, a deemed consideration that gives rise to neither a gain nor a loss. If we deem the disposal consideration to be 20, the same as the cost, 20 less 20, no gain, no loss transfer. That's what's going on. Now that is a rule. The rule is there to stop such situations as, like my example, husband bought an asset for £20,000. It's now grown in value to £30,000. Husband considers it's a good investment and may be likely to go up by another £10,000 in the next 12 months. Now, if he keeps hold of that asset for that extra 12 months, it'll have gone up in value from 30 to 40,000. So when sold to a third party, sales proceeds 40, cost 20, that's a gain of 20. Clearly, without any losses available, that will result in a taxable gain. Clearly, 20 is more than our AEA of £12,000. So the spouses have a clever plan, or so they think. That is, husband sells it to wife for £30,000. He crystallises a gain of £10,000. She acquires at £30,000, or so they think. And then when it goes up by £10,000 the next year, that is the right point to sell. She then sells for £40,000 with a cost of £30,000. Now clearly that isn't going to happen because the transfer from him to her is not at market value. It's no gain, no loss. But see what could happen without the no gain, no loss rule. Hence you'll understand then the reason for that rule. If husband buys for 20, it's now worth 30. If I could sell that to my spouse for £30,000, crystallise a gain of 10, it's covered by my AEA. Next year, it's then worth 40,000. We think that's as high as it's going to go. Good time, therefore, to sell. Wife sells for 40 with a cost of 30. She'd have a gain next year, and that would cover her AEA. We'd be able, if the asset we thought was going to keep going up in value, you could just sell from one to the other in each tax year, using up each year's AEA in the process, and never crystallising a taxable gain. It's not going to work. What we've just said is, if I, the husband, buy it for 20,000, doesn't matter what it's worth when I transfer it to my wife, it's going to be transferred for CGT purposes at cost on a no gain, no loss basis. It leaves me at 20,000, it goes to her at 20,000. If next year she sells it to a third party for £40,000, well, that's it. Proceeds 40, cost 20, gain £20,000. She is deemed to have made all of that gain. So that's why they have the rule. But wherever these rules are there, clearly there's a reason behind it, usually to protect HMRC. But often we see that these rules can be used to our advantage. That's what we'll seek to explain with a little example in this particular note. Right, so as we said, the transfer of assets between spouses or civil partners will always, there's no question of this, always for CGT purposes, be deemed to take place at a value that would give rise to neither a gain nor a loss. As I said to you, this is not an election, it isn't something that you choose to do, it is a rule. This will apply. It is a rule. So don't go on about saying, oh, we might elect for this or not. It's not an election. It is a rule. The transfer is said to be, again, often you may read in other texts, nil gain, nil loss, or as I refer to it as, it's a no gain, no loss transfer. What does that mean? Essentially, the transferor is deemed to make the disposal at his or her cost, and the transferee therefore acquires at the original cost of the transferor. The no gain, no loss transfer rules may be advantageously used by these taxpayers. So we've seen why HMRC have the rule to see what they stop us from otherwise doing. But how do we then take advantage of that? how they can be advantageously used by these taxpayers, spouses and civil partners to utilise, yet again, a basic planning technique we saw last time. You have available each tax year, each spouse for each tax year, an AEA. Use it or lose it. It makes sense, therefore, if we could cash in gains each year of, say, £10,000, less than your AEA of £12,000 there, then if you could do that each year over 5 years, shall we say, you could make £50,000 worth of gains, in total £10,000 a year. And none of those gains would be taxable. Whereas, if of course you just held throughout the entire period of ownership, then a one-off disposal would be a gain of £50,000. And that means, therefore, that once you've covered your AEA, the balance would be taxable. So we know that we want to utilise our available AEA each year of both parties, spouses or civil partners, and to take advantage of capital losses and the lower capital gains tax rate. So as a separate issue, we want to use AEA, we want to use any losses. We ensure, of course, that where we crystallise losses in a tax year, we try to ensure that either that there are no other gains, hence the loss is unused and is carried forward, or there are more than sufficient gains made in that year to benefit from the use of that loss. So we don't end up wasting the loss, taking it out against a gain that would be covered by the AEA anyway. Also here, lower capital gains tax rates. So let's just explain what we've got. For example, it would be better for each spouse to yield gains of £10,000 each, rather than one spouse make gains of £20,000. If one spouse makes in a tax year a gain of £20,000, take out your AEA, you got taxable gains of £8,000, taxable at the relevant marginal rate of tax for that taxpayer, whether that's, again, the lower rate or the higher rate. It would also be better for a basic rate taxpayer to yield taxable gains taxed at 10% or 18%. So, rather than have one taxpayer make a gain of £20,000, it would be better for two taxpayers each to make gains of £10,000. And if we're going to have taxable gains, i.e. gains in excess of the AEA, then better for a taxpayer with available basic rate band to make such gains, rather than one who is already a higher rate taxpayer. So our basic goals are simple. If we're going to make gains, which is a good thing, we'd like to make gains, if we're going to make them, then we would wish those gains, if possible, not to be taxed at all. Why would they not be taxed? Because they would be made in a tax year where the gain is absorbed by the AEA. So if we can exempt gains by always crystallising gains each year equal to, or at least not exceeding, the AEA, then those gains are exempted through the use of the AEA. But life doesn't always work like that. So we may have an individual asset where the gain is going to be greater than £12,000. So in which case, therefore, it's going to be taxable. In which case, if we have a gain that is taxable, let it be taxed at the lower available rate. So it is very basic planning that we've seen before and we'll see again. That is, if you're able to avoid something, income or now gains, being taxed in the first place, i.e. exempting that from tax, that's as good as it gets. But if tax has to be paid, then let it be paid at the lowest available rate. We saw it in income tax, we'll see it again now, we're seeing it again now in CGT. So, it would also be better for basic rate taxpayers to yield taxable gains, because if a basic rate taxpayer is paying tax on a gain, then that's either 10% or 18%, instead of if a higher rate taxpayer yields such taxable gains, where it would be 20% or 28% on the self-same gains. So let's try to use AEA to avoid taxation in the first place, to exempt gains. But if gains have to be taxed between the spouses, if one is higher rate, one is basic rate, let the basic rate taxpayer spouse crystallise those gains. Anything then that has to be taxed, at least to the extent that basic rate band is available to that basic rate taxpayer spouse, let it be taxed at the lower rates rather than the higher rates on the higher rate tax-paying spouse. That makes sense. Okay, now have a little example to illustrate here. We're told, wife has taxable income each year of £60,000, therefore clearly showing us that the wife, without any addition of gains, is purely in income tax terms a higher rate taxpayer. Again, we should agree, I hope, 60,000, that's more than £50,000 of income, and therefore the taxpayer, notwithstanding, of course, whether you've got gift aid payments made or personal pension contributions paid to extend the normal basic rate band, but is a higher rate taxpayer. Husband, on the other hand, has an annual taxable income of only £20,000. Good decision by the husband there, wouldn't you say? That's the way. So, she's a higher rate taxpayer. He very clearly is merely but a basic rate taxpayer. Now, the wife plans, she also owns assets here. Wife plans to dispose of 3 assets that will each give rise to gains of £10,000. And thankfully, your client here has asked for your advice before going out and selling those assets and merely turning up to you and say, oh, look, this is what I've done. Can you tell me whether there'll be any CGT? And if so, how much and when do I pay it? Far better for clients to seek advice before they take action rather than when it's too late after they have taken that action. So wife, sensible here, comes to us and says, right, this is my plan. What should I do? So let's have a look at what the basic game plan would be. At the moment, without your advice, the wife is the only one of the 2 spouses who will have gains. Those gains will be 3 assets, each of which a gain of about £10,000. She would have gains of £30,000. Now then, I want you here to do your basic calculations. If she's got gains of £30,000 for our tax year, you must of course compute the taxable gains. That's merely deduct £12,000 of AEA, of course, there. So 30 less 12, may as well show that, of course, now. AEA 12,000. Then the wife would have taxable gains of 18,000. Given her level of taxable income, the CGT liability would be at what tax rate? Now, of course, we would need to know what type of assets these are, but I think it's fairly obvious we don't have individual gains, probably individual gains anyway, on assets of just 10,000 if it's a residential property. The numbers are probably bigger. But these are not residential property, they're not assets that attract entrepreneurs relief, and on that basis it's other assets. So it is 10% if you were a basic rate taxpayer. She isn't, she's a higher rate taxpayer. Therefore, the CGT liability would be at 20%. 20% on £18,000 of taxable gains would be what? £3,600 of CGT liability. So at the moment, her basic plan is she owns these assets, she wants to sell them, raise cash for whatever purpose, or thinks as an investment basis it would be a good idea to sell them, and that would create a CGT liability of £3,600. Husband has not mentioned any assets that even if he owns them, he doesn't intend to sell any assets during the current tax year. So, our advice would be, it's obviously using the no gain, no loss transfer rule. What we can see here is that the wife, who is a higher rate taxpayer, is crystallising all of the gains using just her AEA and has a taxable gain that is then taxed at the higher of the two rates. While during this self-same tax year, husband doesn't have any taxable gains, is therefore wasting, not yet using his AEA, and if he did make taxable gains, his taxable gains, at least to begin with, given his level of taxable income, would be taxed at 10% instead of 20%. So in which case, you now have to formulate a plan using quite clearly no gain, no loss transfers. Let's think what we're doing. We're going to ensure that each spouse uses their own AEA as much as can be done. It's never going to be perfect numbers, but here let's make sure we use as much of our own AEA as we can. So that would mean that if we got 3 assets, each yielding a gain of about £10,000, then the wife must still at least be selling 1 to use her AEA, and husband needs to have 1 to sell to utilise his AEA. And that would give each of them £10,000 worth of gains. Each has an AEA. None of those gains would be taxable. But there's another asset to be sold with another gain of £10,000. So it means either the wife, she currently owns all 3 assets, or the husband could yield that second gain on that further asset, on the third asset. She's definitely going to sell 1, he's definitely going to sell 1, and then there's 1 more to be sold. Who should make that second sale? Well, as we've seen, if she makes the sale, she's a higher rate taxpayer. So any taxable gain is going to be taxed at the higher rate. Whereas, if he crystallises the taxable gain, you'll be computing this in a moment's time, then assuming, and the numbers here are sufficiently low enough, assuming that he does have sufficient basic rate band available, which he does, then his taxable gains would only be taxed at 10% instead of at 20%. So what I want you to do now is to come up with your plan and establish the amount of CGT saving that you could achieve here for the couple, for the spouses. We know that we've got, if she went ahead with her original idea, and she doesn't know any better than this, we're the advisors here. It's what we are paid to do, to give advice. But she would be looking at a CGT liability of $3,600. You formulate a plan, revise your CGT computation, and see what CGT saving you could achieve. With just a little bit of basic planning skill, you see how much CGT you could save this particular couple. Have a go at that now, and then I'll talk you through the answer to it. Okay, well, I left you therefore with a calculation on your revised plan of what the CGT liability would be under that revised plan, and therefore the saving that could be achieved from the advice that you now give. Again, at the moment, the basic game plan, wife sells all 3. She makes taxable gains of £18,000, using up, of course, all of her AEA for the tax year. And because she's a higher rate taxpayer, those taxable gains are taxed at 20%. So we now want to ensure that we use the husband's AEA, and then ensure that where a taxable gain will arise, it'll be taxed on the basic rate tax-paying spouse rather than the higher rate tax-paying spouse. Who is that? That's the husband. Hence, the plan that you should have formulated would be: wife sells 1 asset, that's to a third party. She crystallises a gain on that 1 asset of £10,000. her gain of 10,000 is covered by her AEA of 12,000. Any unused AEA, of course, would be lost for the year. So she sells one, makes a gain of 10,000, nil taxable gain, it's covered by her AEA. The other two assets now transfers, this is of course on this so-called no gain, no loss basis, two assets to husband. What does no gain, no loss mean? They're transferred at cost. Therefore, when he then sells to the outside world, to third parties, he is making gains of 10,000 on each. Therefore, he will now make gains, 2 times 10,000, some £20,000. That benefits first from his AEA of £12,000, which means that he now faces taxable gains of just £8,000. And of course, the savings are still not complete because those gains are then in his hands taxed at 10%. Now, remember his taxable income was £20,000 in each tax year. That therefore means that up to £37,500 is your basic rate band available. Remember, I gave you taxable income figures there. So with again more than sufficient basic rate band available, those £8,000 worth of taxable gains, they are going to be taxed at 10%. That therefore, again nice simple numbers, will mean a CGT liability of just £800. Compare that with what would have happened if the wife had not taken your advice and simply gone out and done what she thought would be not a problem and sell all those assets for herself. A CGT liability there of £3,600. That can be reduced down to £800, a saving of some £2,800. Now that's a lot of money. So just see from a very, very basic plan there, using no gain, no loss transfers, those two spouses could save themselves £2,800 in tax. That is a very significant tax saving from a very basic plan. Simply utilising each spouse's AEA each tax year, and where gains are to be taxed, let them be taxed at the lower of the available rates, at the lower 10% rate rather than the higher 20% rate. Okay, hopefully therefore no problems so far as those calculations are concerned. And again, when you get to chapter 26, right at the very end of the study notes here, you'll see lots of other circumstances, one or two of which we've already referenced in our notes and lectures up until now, that are ways by which, with just a little bit of planning, we would be able to mitigate the overall tax liability of the individual, or when it comes to spouses, the individuals there. Okay, let's go back to our notes. Back to our notes, we dealt now with the no gain, no loss transfer issue, and there's just one little example there, example 8, for you to have a go at. We have, by name here, Gollum, bought a ring in July 93 for £12,000. Gollum then transferred it to his civil partner Frodo in December 2019 when its market value was £20,000. Frodo then went on to sell the ring in January 2020 for net proceeds of £20,000. Calculate any capital gain for Gollum or Frodo in the 1920 tax year. So what we can see there is we're dealing with civil partners. Transfer between them is no gain, no loss. So Gollum had a cost of £12,000. The fact that when he transfers it to Frodo it was then worth £20,000 is irrelevant. It transfers at 12. He has a no gain, no loss transfer. So neither gain nor loss arises. Frodo then sold the ring in January 2020 for net proceeds of £20,000. It is therefore Frodo who will then crystallise that gain. His cost will be Gollum's original cost. That was 12,000. He sells for net proceeds of 20. It is Frodo that therefore crystallises that gain of £8,000. Again, check out the answer to that, please, in the notes at the back. Okay, well, hopefully no problems so far as the answer to example 8 was concerned. Again, no gain, no loss transfer from Gollum. He crystallises neither gain nor loss. What was his cost becomes Frodo's cost, that of his civil partner. And that means when Frodo then sells at £20,000, his cost was just the 12,000 originally incurred by Gollum. So there's an £8,000 gain that now arises on Frodo. Right, let's go back to our notes. Now, we said that in this session we were looking at very specific special situations where there'd be something different about the capital gains calculation that we perform. And the next situation that we come to is where we deal with a part disposal. So what we're talking about here is a situation where you buy an asset originally in its whole form, and then you are able to dispose of, in the future, a part, but not all of that asset. Again, that may be followed by a further sale of the remaining part. But the problem that we have, if you have a part disposal of an asset that was originally bought as a complete and entire single asset, then when a part is sold, though we know the sale proceeds, though we know the selling expenses, so the net proceeds is the same calculation as it ever was. The problem is, what is the allowable cost? And it's a common issue in terms of issues that arise in calculating a gain. That if we're going to have a calculation problem at all, it tends to revolve around the calculation of cost. You know how much you sell something for. Or if you give it away, you know what it is worth because you're told the market value. If there's going to be a calculation problem here of any of the figures to go into the gains calculation, it tends to be that of cost. And here's one situation in which we have to have a rule by which we deal with this problem where we sell off a part but not the entirety of an asset. How do we divide out from the original cost how much of that original cost of the entire asset, how much should be the allowable cost for the part now being sold? So therein lies your basic problem. As soon as you've solved that problem and you know the allowable cost, feed it into your basic gains calculation and you have your chargeable gain. What would also mean is, out of the total cost of the entire asset, if we've now expended this amount on this part disposal, then whatever remains is the amount of cost to use on any subsequent disposal of the remainder of that asset. We need a rule. Let's have a little look again at the notes now and hopefully understand what they mean. A chargeable asset may be only partly disposed of. For example, now the most likely asset to be tested in this context is land. So here in our example, taxpayer acquires 100 hectares of land and subsequent sells 40 of those hectares. So you bought this parcel of land, 100 hectares. You could at some point sell all of them, or as has happened here, you sell 40 of those hectares. Now you'll know how much you sell the 40 hectares for. You will know the selling expenses that you incur in relation to that sale. But what you know the cost of is the cost of the original purchase of 100 hectares. Go back to our notes. This will give rise to a chargeable gain computed in the normal way. But a specific problem arises regarding what the figure of cost should be to be used now in the gains calculation. Again, logic, not always a good idea with tax, but you might think that logically it would seem appropriate to use 40 100ths to do a physical division of the cost based on the number of hectares, the quantity involved. We bought 100, we sell 40. So take 40 100ths, 40% therefore of the original cost. No, we do not do it that way. we do not use a quantity-based apportionment on that original cost figure. Instead, the rule, and whether you like it or not, this is the rule that must be applied, we apply a value-based apportionment. So what will now happen? Though it may seem appropriate to use 41/100ths of the original cost, given the quantity of land purchased and then sold, however, it's not the basis used, and a market value-based apportionment of the total cost should instead be used. And for this, we need to learn a particular fraction, a part disposal fraction, to allow us to compute the allowable cost. What do? We pick up, of course, the cost of the whole asset, and we need to know what fraction, what proportion of that should now be expended on this part disposal. And we multiply that total cost out by the following fraction to compute that allowable cost of the part now sold. Now, again, it is in that form as it looks at, looking at you in the notes there, the world's most useless fraction, a over a plus b. It's only any use to you if you remember what those figures, those letters rather, stand for. So A is your gross proceeds, and B is the market value of the remainder of the asset at the time of disposal. A figure that you can't make up, it must be given to you in the question. So what we've got is, what are the current sales proceeds on this sale, a figure you know, over the same sale proceeds. Remember, these are gross proceeds, i.e. before deducting selling expenses. Sales proceeds plus value remaining. What is the value remaining of the other part? Again, a figure that has to be provided to you. All you have to do is bring the numbers together. So you will put that through your calculator times by the original total cost and use that, therefore, as the allowable cost on this disposal. Before we use, or before you have a go at example 9, here's one that I prepared for you. So if you just make a note now of the information there, so if you pause at this particular point, copy that down, and then I'll work that through with you. Okay, so what are we told here? A taxpayer had originally purchased a property, in point of fact here, back in 2014, at what was a cost of £60,000. There's your original total cost. Now, in January 2020, so in our 1920 tax year, sells a part of that property for £70,000. It's been split into two, and we sell that first part for £70,000. On that sale, incurring selling expenses of £3,000. So that means that we've got the sales proceeds, we've got the selling expenses, we know what the original total cost was when the whole property, the entire asset was bought, 60,000. We need, therefore, to know what fraction of that 60,000 will now be expended against these proceeds. That, therefore, is the calculation we know: sales proceeds over sales proceeds plus value remaining. Do we know the sales proceeds? Remember which figure? Gross proceeds. Yes, we do. Do we know the value remaining? Well, yes, now we do. At the time of sale, the market value of the remaining part was agreed at £50,000. All right, I will go through, obviously, this with you. There's no other answer. But I'd like you to have a think about that now and to have a go at computing your own figure of a gain in relation to that part. So pause now while you have a go. If it's a problem, don't worry, I will then take you through it. Okay, let's see what gain we have computed therefore. Again, standard calculation. We know how much we've sold this part of the asset for, 70,000, and we know the specific selling expenses that we have incurred. Therefore, our net proceeds at £67,000. The problem was, how much of that original total cost should we now expend against this particular disposal? Answer: use the fraction sales proceeds over sale proceeds plus value remaining. In this respect, remembering that the sales proceeds figure we use is the gross rather than the net proceeds. So what was our sale? Our gross proceeds, £70,000. So times 70,000 over the self-same 70,000 plus the value remaining there. That was some £50,000. Therefore, 60,000 rather, times 70 over 70 plus 50. 70 plus 50 is 120. 70 over 120, 7/12 of 60,000, the original total common cost. That therefore will be, well, 1/12 of 60 would be 5, so that's going to be 35,000, all being well, as the allowable cost. Take it away from your net proceeds of 67, leaving you with a chargeable gain of £32,000 there. So thus allowing us on that disposal to compute the gain arising. A couple of other points just to note. If there were individual costs incurred on the two individual parts of that property, if we could specifically identify costs on this bit of the property, then those would be deducted in full. This calculation applies to the common costs, those shared by the entire property. So that's on the common total cost. If you had specific expenses, like in converting this part of the property into a separate saleable entity, then those costs would be deducted in full because they're specific to that one part. That fraction, gross proceeds over gross proceeds plus value remaining, that is to be applied to the joint or common cost applicable to the entire asset. Another situation that the examiner could put you in, it might be that actually what we've just looked at here, this disposal, is not actually the object of the question. That what happened is that this original disposal of the first part of the property occurred some years ago. And what is now happening is the taxpayer is selling the remaining part. Now again, you would know what are the sales proceeds. You would know what are the selling expenses. But what we also know is that out of an original common cost of £60,000, we have already expended, achieved as an allowable cost in a capital gains calculation, some £35,000 worth of that original total cost of 60. So if we've already used within our first part disposal calculation 35,000 out of the 60,000 allowable cost, what much or how much of that original 60,000 still remains to be expended at the point at which the second part, the remaining part of the property, is then sold? Very obviously, 60 minus 35 is £25,000. So when you do that first part disposal, it tells you what amount of cost still remains. Now, it is most likely that the question you get in the exam would be this one, working out that first allowable cost figure based on your part disposal calculation. But as a more interesting style of question for you to watch out for and to think about before you walk into the examination room would be, we now deal with the sale of the remaining part, the first part disposal having already occurred. You need to go back to that earlier part disposal, like we have done with this one, work out what then was the allowable cost that we were permitted to go into the gains calculation. Doesn't matter now, a year, 2 years, 3 years later, what the then gain was. What matters is that number there, that we used 35,000 out of an original total cost of 60. We've used 35 out of 60, so what is now left to go against this disposal on the remaining part? £25,000. Use that as your allowable cost, work out your capital gain accordingly. Okay, That's enough for this session, therefore. In what will then be our final session on, again, it's always a long chapter to use the first chapter on any new tax, where we lay down the basic systems there. But in that next and final chapter, final lesson section, I should say, on this particular chapter, we will look at a few other very specific circumstances and how in specific problems we derive specific answers to solve those problems being how do we calculate a gain, how do we calculate a loss, is there a gain or loss indeed to be computed. So we finish off this chapter in our next session together.